everyone, and welcome to the Currency Exchange, a NatWest podcast all about foreign exchange markets. I'm Brian Daingerfield. I cover G10FX strategy from the US, and today I'm very happy to be joined by Paul Robson, who covers G10FX strategy with me over in London to discuss major currencies this week with a particular focus on some European currencies, as well as what happened in the US week with the Fed. So, Paul, thanks very much for joining.
Thanks very much, Brian, for the invitation. Very much looking forward to it. Like you say, quite a lot to digest on both sides of the Atlantic this week.
Yeah, I'd like to start on your side of the Atlantic, talking about the Bank of England specifically. I know there's been a lot of interest in policy divergence opening up, not just between central banks and the Fed, but also within regions and particularly within Europe. I did want to ask your opinion on what the Bank of England, we do have a Bank of England decision coming up. What are you expecting for the Bank of decision coming up soon?
Yeah, so the decision from the Bank of England comes next week. We're not expecting any change in policy, nor is the market. I think we've just got a couple of basis points that's priced in, so no one really expecting much. There's a couple of people talking about a surprise cut in interest rates at the May meeting, but I would say that just they risk snatching defeat from the jaws of victory, having waited so long for more confidence and evidence about inflation coming down. We don't see any reason why they would try and jump the gun and cut interest rates a little bit earlier than the market's expecting. As normal, that just leaves the focus on sort of various parts of the vote count, the inflation projections, and the overall tone of the minutes and the statement and the press conference. And within that, any sort of hints we think about whether they'll go in June or wait to August. That's our preferred expectation. But importantly, I think, and this is ultimately what will matter for the currency when we get on to that, is the degree of monetary easing that the Bank of England might deliver after that first all-important rate cut. As I said, we think that comes in August. In terms of what we're expecting an 8-1 vote in favour of unchanged rates, one person dissenting voter voting for a cut, so matching the previous meeting. But it's the inflation projections, I think, where you could get a dovish surprise, because the inflation numbers that have been being published have been a little bit weaker than expected. Some second-tier inflation indicators on shop prices and wages have all been going the way of the Bank of England. But it's the assumption the bank will make about market interest rates assumptions. And when they did their last set of forecasts, interest rates were expected to be cut 50 basis points more than currently priced. So just mechanically, you would think that inflation forecasts would be lowered. Now, there's always the dark arts of inflation forecasting, and you can tweak all kinds of things to deliver the policy signal that you want. But given the degree to which markets have priced out cuts, maybe the Bank of England just wants to sort of push against that a little bit. And the overall tone, we think, of the press conference, and a bit more explicitly dovish, might be the key, ultimately key takeaway for rates markets, at least, from next week's decision.
Great summary there, Paul. As I look at the market pricing for the Bank of England meeting over the next couple of meetings, looks like about 10 basis points priced for June, with closer to 25 priced for August. And so, to your point, I think it really does feel like this is going to be all about the tone and whether or not the Bank of England says something that pushes the market towards either more than 50-50 chance of a cut in June, or whether or not it sort of pushes back against that. We've certainly heard from different Bank of England officials over the last couple of days giving, some markets, maybe some, I don't want to say conflicting signals, but expressing sort of different views on, the progress of disinflation and whatnot. So definitely an interesting one coming up. How does this all feed into sterling in your mind? I know, the pace of cutting, the timing of cutting, and relative interest rates has been such a big influence on not just sterling, but all currencies this year. How are you thinking about sterling now as we take not just these developments in the UK, but also how they relate to what we're seeing from, or expecting to see from the ECB, and also developments with the Fed?
Yeah, I think the outlook for sterling is turning more negative on that sort of expected repricing of short-term interest rates. As you say, markets have got about 40 basis points of easing priced in between that first rate cut, whether it comes in June or August. I don't think that really matters for the currency, but the market is forecasting to like 25 and then 25, so once a quarter. Our economics team think that once they get going, they're going to deliver quarter point cuts at each of the remaining meetings, so 100 in total. So the difference between what our economics team are expecting, what markets are currently pricing, is 60 basis points. And that matters for currencies. And if that gets repriced in splendid isolation, now obviously curves can be repriced together with, you've seen that with the Fed, haven't we, over the last sort of 6 weeks. That's the development that probably has caught most people out. That would be negative. And I think it is yield that is the dominant focus. So 4 factors, I think, when looking at a sterling outlook, you need to consider. One is relative yield. Another is relative growth. You've got the balance of payments, the dynamics, which is a third, and you've got the risk premium. And I think the risk premium in the currency is relatively stable. This isn't 5 years ago when that moved around greatly. Relative growth, relatively stable at low levels. I don't think we're going to get a significant change in that. And current account dynamics, this isn't the energy crisis of a couple of years ago when we could look for that to move the balance of payments. So it is yields that are going to be important. So if we get that repricing, I think that's going to be negative. So sterling to trade weekly. But as you said at the opening comments, policy divergence does seem to be building. If we think that the the Bank of England is repriced, and we've just had the Fed, I was just curious to know what your thinking is on the Fed now, and how you think that's going to affect the dollar, because that's obviously going to be a key driver of sterling dollar and a euro dollar.
Yeah, I think from the global currency perspective, I think one of the big themes that we're all tracing now is how much of this hawkish Fed repricing needs to be sort of expanded into other economies versus how much ability other economies have to stay with a very easy policy outlook. And sterling is one of the theaters that this is really going to play out in. Is our expectations for Bank of England are much more dovish than they are for the Fed. And I'll touch on the Fed in a second here, but whether that's appropriate or not, and maybe just as importantly, how quickly can the market, or how durably can the market price towards that, is going to be impacted by market assumptions about how elastic is Fed pricing, how willing are economies to move much faster and much more dovishly than the Fed. This all leads into what we've seen for the May FOMC meeting, which happened on Wednesday. I think this was largely a placeholder meeting because the Fed, like the market, is waiting for the data. There was a hawkish adjustment to the FOMC statement, and Powell's press conference did include a couple of hawkish references that I think reflect the changes in the data that have happened. I don't think he necessarily expanded on that or necessarily took away from it. I think the market response to the data, the very strong April CPI in particular that we got, the March CPI that was released in April, as well as the general strength of the data. Powell said before this meeting that there was likely to be lower confidence in inflation trending back down towards 2%, or at very least it would take longer. And that would probably mean that it will take longer to consider cutting the policy interest rate. And that language used before the meeting was almost word for word incorporated into the Fed's new guidance. So Powell used a pre-FOMC meeting speech to really signal the evolution of the guidance. Now, the market response to the actual decision was a bit dovish in the initial interpretation, and I think that's right, if only because this meeting was all about whether or not Powell would start talking about interest rate hikes coming back on the table for the Fed. And I think Powell tried to go out of his way to suggest that that's not the base case currently, that there are conditions under which rate hikes come back on the table because of data dependence, but that it's not the base case yet. And I think what he was trying to say is that, yes, inflation has come in much higher than expected. Yes, progress has been slowed, but we haven't yet reached the standard where interest rate hikes are actively being considered. Instead, the reaction function is towards pushing out the potential timing for interest rate cuts. And so I think the market came into the Fed meeting on Wednesday anticipating the risk reward being that Powell talks a little bit more openly about the prospect of rate hikes. Instead, he seemed to be trying to actively avoid that conversation. He was asked several times, and in most cases, sort of tried to push the conversation back towards recent data in making it a higher for longer stance of policy rather than increasing interest rates as the most appropriate outcome. So the FOMC decision, I think, did provide some, was interesting in the sense that it provided a baseline for where the Fed is now, and the Fed didn't necessarily didn't move as far in the hawkish direction as I think the market was fearing that it might. But I think there's some limits to how much the Fed's language can move the dollar and move markets at this stage, because the Fed, like the rest of us, are all just watching the data. In particular, the non-farm payrolls number, which comes out tomorrow. You'll have that number in hand as you're listening to this podcast, which is released on Friday morning as we record on Thursday afternoon. But you'll also have the CPI numbers coming up later this month, in the month of May. And unfortunately for the Fed, and maybe fortunately for the dollar, we're not expecting a lot more good news on CPI coming in the near term. In fact, just based on the strength in the core PCE deflator that we got at the end of the month, and additionally some other changes in some sort of smaller changes in our inflation projections, we're actually thinking it's possible that core CPI, the month-on-month reading, which we know the Fed is very focused on, could come in as high as a high 0.3% or even round up to a 0.4%. So another very, very strong CPI number, an uncomfortably high CPI number may be coming if our forecasts are realized. And so the Fed, I think, sort of tried to push back that conversation about whether rate hikes would come back on the table. But I think it's certainly possible that the data keep the Fed in a defensive mode, keep the market in a defensive mode, and keep this prospect of policy divergence and what it means for the dollar and global currencies very much front and center of mind for global currency markets. Paul, I want to come back to you and talk about some other economies in Europe. I want to start with Norway. Just like the non-farm payroll number, which you'll have in hand by the time you hear this, you'll also have the fresh Norges Bank decision, which will also be released, which will also come out on Friday morning. But I did want to ask you to discuss the policy path and sort of the outlook for Norway here. What are some of the themes going on in Nordics right at the moment? Just would love to hear your thoughts on Norway specifically as we look at as we think about policy divergence and the general trend of energy prices and other developments in the region.
Yeah, as you say, sort of podcast gymnastics. So we've got to preview a policy meeting that by the time this podcast gets released, people will already have seen it. But I think we'll have to sort of look through that. And as you say, there's lots of moving parts in European FX, but also particularly in the Nordic region. So I think it's an interesting meeting. And certainly when we think about one of the key things that we've had, policy divergence, early easers versus late cutters, I think one of the key things for Norway will be that they're a late cutter. And also the other theme for both the Norges Bank and Riksbank, and maybe for other central banks around the world, most notably sort of EM central banks, the impact on their currencies of their policy decisions and the extent to which currency weakness feeds through into inflation and inflation expectations, and that's something that they've got to be mindful. And I think Norges Bank will be mindful of that. So, in terms of those podcast gymnastics, it's helpful that it's an interim meeting from Norges Bank, so I don't have to run through a set of new updated forecasts and the expected rate path. And the biggest reaction will come if there's any change in the statement. So at least that makes it a little bit easier. As I said about currency moves, the Norwegian krone has been 3% weaker than at the time of the last monetary policy report back in March. And I don't think Norges Bank will want to say that much. One, that emboldens short-term interest rate moves to price in earlier and deeper rate cuts that obviously drive or may drive the currency even weaker. And I think that will come through in the statement. So no change in rates. They'll keep to their guidance. They'll probably make some reference to the previous expected rate path. And I think just that confidence that rates are going to stay higher for longer, maybe because of the exchange rate, and growth in the economy is a little bit better because you've got the lagged impact of petroleum investment that is a differentiator for the Norwegian economy for the rest of Europe, and I think that will come through. So no change in the view that Norges Bank is a late cutter in terms of interest rates and supportive of the currency. So some of the weakness that we've seen, I think, will probably be given back, or has potential to be given back over coming weeks.
So you also mentioned Riksbank, and of all the central bank decisions that we've talked about so far, this one feels like the only one where an actual change in policy really looks live. I think markets are pricing almost 50-50 chance of a rate cut at this meeting, their meeting coming up next week. I think the big question is, can the Riksbank move before the ECB? The ECB looks pretty baked in at this point. They've been signaling a June cut for several months now. Do you think the Riksbank pulls the trigger next week before the ECB, or do you think they hold off?
Yeah, I think that they do go, actually. 25 basis points cut is our expectation. But as you say, it's a fine decision because just like Norwegian kroner, the Swedish kroner has also been weakening. The governor of the Riksbank's been a little bit more explicit. He was saying that, of course, they could cut ahead of the Fed and ECB. I don't know to what extent that's sort of central bank bravado, but the data supports that view. Inflation has been coming down more quickly than they had forecast. So they will have confidence that inflation is coming sustainably back down to target. The economy has been weak, higher interest rates, debt servicing costs for a leveraged economy gives the desired pass-through from monetary policy into the real economy, into prices, and that's working pretty well. Economists across the street seem more confident than the market pricing that they deliver a cut next week. So we haven't seen all the previews across the street, but probably about 80% of economists think that they go. And as you quite rightly pointed out, market pricing is more 50-50. So that combination suggests that the currency does move. And given our expectation for the Norges Bank and for the Riksbank, and they cut, I could see the Norwegian kroner doing relatively well against an under pressure Swedish krona if the Riksbank deliver. But like you say, of all the three central banks that we've spoken about, maybe that's the one that is going to be a short-term focus. Obviously, the other sort of central bank or the currency that's been in focus of late, Japanese yen and the Bank of Japan, and this policy divergence between what the Bank of Japan's doing and other central banks, with sort of that elusive easing cycle from the Fed. But how are you seeing the yen and the outlook here?
Yeah, and I mean, I won't go too deep into yen because we did have a full podcast release in our last recording, which came out on Tuesday. So check out that release for a sort of a full discussion of yen in context of the Bank of Japan decision and of the intervention, the widely suspected, if not all but confirmed, FX intervention that we have had. I think one of the big sort of new developments since we recorded that release on Monday was that we have each time the BOJ MOF steps in and delivers intervention, or at least is suspected to based on the moves in price action, we get a bit of a better sense of maybe what the strategy is behind intervention and what the goal might be for intervention. So a couple things to consider as we think about trying to time future interventions. First one is the timing of interventions. What sort of timing during the day? Are they going during active Tokyo hours? Are they going during relatively liquid times or during illiquid times? And what we saw, a big move on Wednesday afternoon in the US, sort of 4 p.m. in the US, so before the Tokyo Open, but sort of at the closing time in the US, we saw a big down move in dollar yen that certainly looked like it could be another round of intervention. So that would be the second time in a week that the Ministry of Finance may have been intervening at a time that was relatively illiquid, an illiquid market period. So they intervened during Tokyo hours on Monday. However, it was a holiday in Tokyo on Monday. So it was a relatively illiquid period, right? And so from a pattern perspective, if we're trying to look for patterns to try and predict what the goal of intervention might be and what kind of conditions we could have for future interventions, one that stands out is that the MOF may be looking to act during illiquid times, with the goal being to maybe push, to get maybe a bit more bang for their buck in terms of intervention. That, if you're pushing against a relatively illiquid market, if you're the MOF doing a significant sized intervention during a time when there's relatively little market activity, that could enhance the potential moves that you would get, relative to moving in more liquid time. So that's one thing that I think we can point to as a potential pattern around interventions. Another one that's really interesting to think about is, what is the goal of the Ministry of Finance? Is it to push back against periods of yen weakness, or is it to maybe try and enhance periods of yen strength? So from a momentum perspective, what are they trying to do? Are they trying to stop downside yen momentum, or are they trying to enhance upside yen momentum in those fleeting moments recently when they actually do see it? And I think this week we've seen examples of both. We saw on Monday, the intervention in yen on Monday was in response to significant weakness in the post-BOJ reaction, both on Friday session and through the Monday morning, the illiquid period on Monday morning in Tokyo that pushed dollar yen above 160. That felt like a move to try and reverse downside pressure on the yen. If we assume that the sharp down move we saw on Wednesday afternoon after the Fed was also intervention, that looks to be more intervention in the other direction, because the dollar, as I mentioned, had weakened against a variety of currencies. US rates had fallen in the immediate aftermath of the Fed decision, which the market interpreted as dovish, simply because it didn't necessarily advance the hawkish ball further in the direction of putting rate hikes more specifically on the table. And so dollar yen was already lower on the session, but that intervention came sort of with momentum moving better in their favor in terms of lower dollar yen rather than higher dollar yen. So very interesting to see as we try and think about what are the conditions. Looks like we might have examples of the Bank of Japan, Ministry of Finance, Bank of Japan, taking both approaches, where you are trying to lean against momentum when it's out of your favor, but also trying to potentially lean into momentum when there seems to be some downward momentum. Of course, all of this is not to say that intervention is a panacea, that intervention solves some of these critical issues. If anything, the widening of policy divergence between the Fed and the Bank of Japan has never been as stark as it is now. And if we're right that the CPI continues to sort of give bad news to the Fed, that might be something that, from a fundamental perspective, keeps the yen under pressure. And it seems like the Ministry of Finance is, responding to the symptoms of that policy divergence rather than a big change in fundamentals that's really providing a lot of support for the yen. So I think that's all we have time for today. Paul, thanks very much for joining. And to our listeners, thanks very much for listening to today's episode. If you enjoyed this episode, please consider giving our channel a like and also subscribing so that you get our latest podcasts the moment they're released. Thank you very much.